Gold just broke $4,500, and nobody is telling you the real reason why. Curious, the truth behind the crash, the war, and what comes next. Let me tell you something that nobody in financial media is saying right now. Size. Gold did not crash because gold is broken. Gold did not crash because the bull market is over. Gold did not crash because smart money is running away from precious metals. Gold crashed because the most powerful financial institutions on the planet were forced, not chose but forced, to sell their most liquid assets in a matter of hours. And when institutions that hold hundreds of billions of dollars in gold need emergency cash at the same time, the price does not care about fundamentals. It does not care about war. It does not care about inflation. It does not care about anything except the immediate, desperate need for liquidity. And right now, as you watch this video, that forced selling is happening against the backdrop of something that has never happened before in the modern financial era. The deliberate, systematic, coordinated destruction of energy infrastructure across 4 sovereign nations simultaneously. This is not a correction. This is not a bear market. This is not 1979. And by the time this video is over, you will understand exactly why, with numbers, with data, with the actual mechanics of what is happening in the gold and silver markets right now, and more importantly, what happens when the dust settles. Stay with me, because what I'm about to show you is the most important financial analysis I have ever put together. Part 1. What actually happened in the last 72 hours. Let us start with the facts, raw, unfiltered, and in sequence, because the timeline matters enormously to understanding what gold is doing. Israel struck South Pars. If you do not know what South Pars is, let me give you the proper scale of that decision. South Pars is not a military installation. South Pars is not a weapons depot. South Pars is the single largest natural gas field on the face of the earth, sitting offshore in the Persian Gulf, straddling the border between Iran and Qatar. It supplies 80% of Iran's electricity. 80%. That is not hitting a military target. That is hitting the beating heart of a nation's energy supply. That is telling 90 million people that their lights, their hospitals, their water treatment plants, their entire modern infrastructure, all of it, is now at risk. Iran's response did not take long. Within hours, Iran launched what can only be described as the most strategically sophisticated energy warfare campaign in the history of modern conflict. Not a single target, not a single country, 4 countries, simultaneously, coordinated, systematic. And here's what that looked like on the ground. Qatar. Ras Laffan Industrial City took missile strikes. This is not a random industrial zone. Ras Laffan is the headquarters of Qatar Energy, the operator of the world's largest LNG export terminal on the planet. Qatar supplies approximately 20% of the world's liquefied natural gas. Not 2%, not 5%, 20%. The strikes caused what Qatari officials described as extensive structural damage, not just fires that can be extinguished, but physical damage to infrastructure that could take months or years to repair even after the last missile falls. Within 24 hours, Qatar had expelled Iran's military and security attachés and declared them persona non grata. That is extraordinary. Qatar was the country hosting nuclear negotiations between Iran and the United States just weeks before this attack. They were the mediators, the trusted neutral party, the bridge between 2 enemies. And they just threw Iran's diplomats out of the country. When the mediators become enemies, the path to a ceasefire does not get shorter. It disappears entirely. Saudi Arabia. Iran struck the Samref refinery in Yanbu, a joint venture between Saudi Aramco and ExxonMobil located on the Red Sea coast. Now, most people hear refinery attack and think, bad, but manageable. What they do not understand is the specific strategic significance of Yanbu in this exact moment of this exact war. The Strait of Hormuz is closed. The port of Fujairah in the UAE has been under repeated assault. Saudi Arabia had been rerouting every single barrel of its oil exports westward, through pipelines, through the Red Sea, through Yanbu, specifically to avoid the war zone in the Gulf. Yanbu was the escape route, the one remaining pathway through which Saudi oil could reach global markets, and Iran just hit it. A ballistic missile was also launched toward Yanbu. It was intercepted, but the message was unmistakable. There is no safe corridor left. Saudi Arabia's foreign minister responded by saying that whatever minimal trust existed before this attack has now been completely and irreversibly shattered. He added that the kingdom reserves the right to take military action against Iran. Let that sink in. Saudi Arabia, the country that has bent over backwards to stay neutral in this conflict, The country that has rerouted its entire export infrastructure to avoid getting drawn in is now publicly reserving the right to go to war. That is a new country entering the conflict, and if Saudi Arabia engages militarily, this war does not stay a US-Israel operation anymore. It becomes a full regional war involving the entire Gulf. And full regional wars do not produce $60 oil. They produce $200 oil. Kuwait. Drone strikes hit the Mina al-Ahmadi and Mina Abdullah refineries. Both facilities caught fire. Mina al-Ahmadi alone processes 730,000 barrels per day, making it one of the largest and most strategically important refineries in the entire Middle East. Both facilities are now compromised, dealing with structural fire damage in the middle of a war that has no defined endpoint and no ceasefire in sight. The UAE. Authorities shut down the Habshan gas facility and the Bab oil field after intercepted missiles sent shrapnel and debris directly into the facilities. Habshan is not a small operation. It is one of the largest natural gas processing complexes anywhere in the world. 5 interconnected plants with a combined daily processing capacity of 6.1 billion standard cubic feet. Shut down. Not damaged and limping along at reduced capacity. Completely shut down. And this is a country that has endured 334 ballistic missiles, 15 cruise missiles, and 1,614 drones since February 28th. Those numbers come directly from the Emirati Defense Ministry. In less than a month, Iran has fired more ballistic missiles at the UAE than most countries face in the entirety of a conventional war. This is the context in which gold crashed. This is the environment in which silver is trading below $70. This is the war that caused $7.5 trillion to be wiped from global financial markets in under 48 hours. Part 2. Why gold crashes when the world is burning. This is the part that confuses most people. And I understand why it is confusing, because on the surface, it makes absolutely no sense. The world is on fire, literally. 4 countries have burning refineries. The Strait of Hormuz is closed. Oil is above $118. Inflation is raging. The Fed is trapped. And gold, the asset that is supposed to protect you from exactly this kind of chaos, is crashing. How is that possible? Here is exactly how it works. When a crisis of this magnitude hits, not a normal recession, not a routine market correction, but a genuine black swan event that moves oil 40% in a week, institutions do not think about safe havens. They think about survival. They think about their margin calls. They think about the phone calls they are getting from their prime brokers demanding more collateral right now, today, this morning, before the market opens. Picture a large hedge fund. They hold a diversified portfolio: equities, oil futures, gold, silver, bonds, private equity, real estate investment trusts. The war escalates overnight. Oil spikes from $85 to $118. Their oil futures position is showing a massive unrealized gain. But their equity portfolio is down 15% in 2 days. Their bond positions are getting crushed by inflation expectations. And their prime broker is on the phone telling them they need to post $2 billion in additional cash collateral by market open or face forced liquidation of their entire book. They cannot sell the oil futures. The position is profitable, but more importantly, the war is still going. Selling oil into a war is leaving money on the table. They cannot sell the stocks. The market is locked limit down. There are no buyers. They cannot sell the bonds without crystallizing enormous losses. But they can sell gold. Gold trades 24 hours a day. Gold has deep, liquid markets in London, New York, Shanghai, Dubai. Gold can be sold in any size at any hour without moving the market catastrophically, and so they sell gold. Not because they want to, not because they think gold is going lower, but because gold is the only thing liquid enough to raise $2 billion in the next 3 hours. Now multiply that scenario by 500 funds, 1,000 funds, all of them receiving margin calls at the same time, all of them reaching for the same asset to liquidate, all of them selling gold not because of any rational assessment of gold's value, but because gold is liquid and they need cash. This is what a liquidity crisis looks like. The selling is not analytical, it is mechanical, algorithmic, automatic. And it creates something very important for investors who understand what is happening. It creates a price disconnection. The price of gold stops reflecting the value of gold and starts reflecting the desperation of institutions that need cash immediately. Gold at $4,500 when oil is at 118s and PPI is running at 3.9% core and the Fed is trapped between inflation and recession. That is not a fair price. That is a panic price, a liquidation price, a price that exists because of mechanical selling pressure, not because of any fundamental analysis. And here's the most important thing I can tell you about liquidation prices: they do not last. The cash gets raised, the margin calls get covered, the forced selling exhausts itself, and then, often violently and rapidly, the market reprices based on actual fundamentals. The same institutions that sold gold at $4,500 because they had to will buy gold back at lower prices because they want to, because they are not stupid, because they understand what inflation does to real assets, because they understand what wars do to energy prices, because they understand what a trapped Fed means for real interest rates. They sold because they were forced to. They will buy because the fundamentals demand it. Part 3. The 1979 comparison and why it falls apart under scrutiny. The comparison everyone is making right now is 1979. I have seen it on every financial channel, every gold newsletter, every trading forum. The chart overlay looks terrifying. Gold's current pattern appears to mirror the 1979 Iran crisis almost point for point. And if the pattern plays out completely, gold still has another 40 to 47% to fall from current levels. That would put gold below $3,000. I want to take this comparison seriously. I am not going to dismiss it. I am going to examine it point by point using actual data, and then I am going to show you precisely why the 1979 analogy, while visually compelling, does not hold up when you put real numbers next to real numbers. First, the magnitude of the rally leading into the crash. In 1979, gold had just completed one of the most extreme speculative manias in modern financial history. It ran from $35 per ounce in 1971, when Nixon closed the gold window and broke the Bretton Woods system, all the way to $850 per ounce at its January 1980 peak. That is a 2,400% move, 2,400%, driven almost entirely by speculative buying, the collapse of monetary order, and retail investors piling in with leverage because gold was going up every single day. Blow-off tops of that magnitude, 2,400% parabolic moves, have only one direction to go afterward: down, hard, fast, and for a long time. Now look at the current cycle. Gold moved from approximately $2,000 per ounce in late 2023 to its peak of $5,600, a move of roughly 180%. 180% is a strong bull market move. It is not a 2,400% speculative mania. It is not even close to the same category of move. Blow-off tops do not happen after 180% rallies. They happen after 10x, 20x, 30x moves. The mathematical foundation for a 47% crash simply does not exist when the preceding rally was less than a tenth the size of 1979. Second, who is actually buying gold and why? In 1979, gold demand was almost entirely speculative retail. Investors were buying gold not because of strategic monetary allocation, not because of geopolitical reserve diversification, but because it was going up and they did not want to miss out. The classic definition of speculative mania. Central banks at that time were actually selling gold. They were getting rid of it, not accumulating it. The demand structure in 2026 could not be more different. Central banks globally have been purchasing gold at record pace, over 1,000 tons per year for 3 consecutive years. China has been buying for 15 consecutive months without interruption. Russia, India, Turkey, Poland, Hungary, BRICS nations, and emerging market central banks are systematically building gold reserves as a strategic alternative to dollar dependency. This is not speculative retail demand. This is sovereign, institutional, strategic demand from the largest and most sophisticated buyers on the planet, and strategic institutional buyers do not panic sell during a crash. They see lower prices as an opportunity to accelerate their accumulation. Third, the physical market structure. In 1979, there was no physical tightness driving gold prices. There was no COMEX vault drain, no Shanghai premium, no lease rate crisis, no exchange halts. The gold that was being traded was paper gold, futures contracts and speculative positions, with essentially unlimited supply of paper claims available to dampen any rally. The physical gold market in 2026 is under the most severe stress in modern financial history. COMEX registered vaults have been draining steadily for months. The Shanghai Futures Exchange has seen its gold inventory compress to critically low levels. London froze in late 2025, something that had never happened before in the history of that market. The CME halted trading twice. Silver lease rates hit 12%, meaning the physical metal is so scarce that borrowing it for 12 months costs 12% of its value. JP Morgan alone pulled 1.6 million ounces of silver from its own COMEX vault in a single day this week. Physical tightness is the structural floor that did not exist in 1979. You cannot have a 47% sustained crash when the physical market is simultaneously experiencing withdrawal rates and premium structures that indicate genuine scarcity. Paper price and physical reality must eventually converge. And when they converge during a period of physical tightness, they converge upward, not downward. Fourth, the interest rate environment. This is perhaps the most critical difference of all, and it is the one that financial commentators comparing 2026 to 1979 consistently fail to address honestly. Gold's crash after 1980 was not caused by the chart pattern. It was not caused by speculative exhaustion alone. It was caused by Paul Volcker raising the federal funds rate to 20%. 20%. When you can earn 20% annually, risk-free, government-guaranteed, in a savings account or a treasury bill, the opportunity cost of holding gold becomes enormous. Why hold an asset that pays no yield, requires storage, and just crashed 40% when you can earn 20% guaranteed? Volcker's rate hike was the death blow. The chart pattern was just the symptom. Now ask yourself, is there any scenario in which the Federal Reserve raises rates to 20% in 2026? The answer is categorically no. The U.S. government is carrying $38 trillion in national debt. At 20% interest rates, the annual interest payments on that debt would approach $7 to $8 trillion, roughly double the entire federal budget. The U.S. economy would collapse before gold would. The Fed is not going to 20%. The Fed is not going to 15%. The Fed is not going to 10%. The Fed is trapped at current rates, unable to cut because inflation is raging above forecast, unable to hike because the economy and the debt load cannot tolerate higher rates. There is no Volcker moment coming. There is no interest rate mechanism by which gold gets killed the same way it was killed in 1980. 4 differences, 4 data points, 4 reasons why the chart overlay, while visually alarming, does not tell the complete story. Part 4. The exact levels I am watching. Let me give you the precise technical levels that matter right now. Not opinions, not feelings, but the specific price zones where real decisions need to be made. Gold, $4,500. This is the immediate support level. It held last week during the initial wave of selling. It is being tested again right now as the second wave of institutional liquidation hits the market. If this level holds on a closing basis, it suggests the forced selling is beginning to exhaust itself, and the first stabilization is forming. Gold, $4,300. This is the critical annual support, the level that held during the January crash and served as the launch point for gold's subsequent rally to $5,400. If $4,500 fails to hold, $4,300 is where I expect the largest concentration of strategic buying to appear. Central banks, sovereign wealth funds, and long-term institutional holders who have been waiting for lower prices will defend this level aggressively. Gold, $4,000. This is the absolute line in the sand. If gold reaches $4,000, and I want to be clear, I consider this a low probability scenario given the physical market tightness and strategic demand. But if it reaches $4,000, the entire bull market structure comes into question and a much more serious reassessment is required. I am watching this level not because I expect it, but because every serious investor needs to know the worst-case scenario so they are not blindsided by it. Silver, $70, the immediate level. Silver has already broken below $72 and is testing $70 as this video records. Silver moves more violently than gold in both directions because it is a smaller market with less institutional liquidity support. The current selling pressure will likely push silver toward a complete retest of its previous low. Silver, $64. This was the washout low from the previous crash. In a functioning bull market, retests of previous lows serve as powerful accumulation zones. The $64 level represents where institutional buyers stepped in forcefully last time. And if silver reaches that level again in this cycle, the same dynamic is likely to repeat, perhaps even more aggressively given the deterioration in physical inventory since then. Part 5. The big picture fundamentals that have not changed. I want to zoom out completely from the daily chart, from the hourly panic, from the burning refineries and the diplomatic expulsions and the missile intercepts, and remind you what the underlying fundamentals actually say about gold and silver. Core PPI just came in at 3.9%, more than double what economists had forecast. That is the hottest producer price inflation in 3 years. Producer prices lead consumer prices. What factories pay today, consumers pay in 3 to 6 months. The inflation story is not over. It is accelerating. Oil is above $118 per barrel, with 4 countries' energy infrastructure simultaneously damaged or shut down. Energy is an input cost for literally everything: food, manufacturing, transportation, utilities. $118 oil does not produce lower inflation in 6 months. It produces higher inflation. Food prices are surging. Vegetables alone are up 49% year over year. Supply chains are fracturing under the combined pressure of energy costs, war disruptions, and the closure of the Strait of Hormuz. The Federal Reserve has no functional tools left. Rate cuts are impossible with 3.9% core PPI. Rate hikes are impossible with a cracking economy and $38 trillion in debt. The Fed is in a box, unable to fight inflation without crashing the economy, unable to support the economy without exploding inflation. The US dollar is strong right now, temporarily, because of the liquidity scramble. When institutions need cash, they buy dollars. When the dust settles and the margin calls are covered and the forced selling exhausts itself, the dollar will begin to reflect its actual fundamentals. $38 trillion in debt. $1 trillion added every 100 days. $1 trillion per year in interest payments alone. A war adding billions per week in defense spending with no defined endpoint. Those are not the fundamentals of a strong currency. They are the fundamentals of a currency that needs a hedge, and that hedge is gold. None of these fundamentals have changed because gold dropped from $5,400 to $4,500. The war has not become less severe. The inflation has not become less persistent. The debt has not become more manageable. The Fed has not gained new tools. The physical gold has not reappeared in the vaults. The paper price has changed. The fundamentals have not. Part 6. What happens when the liquidity crisis ends? History gives us a very clear roadmap here. Not the 1979 roadmap that leads to a 47% crash, but the roadmap from every genuine liquidity crisis in the modern era. March 2020, COVID pandemic. Gold crashed from $1,780 to $1,177 in a matter of days as institutions liquidated everything for cash. Within weeks, gold was back above $1,300 and on its way to new all-time highs above $2,000. September 2008, financial crisis. Gold dropped sharply as the deleveraging cycle forced institutional selling. Within 6 months, gold was recovering. Within 2 years, it had more than doubled. The pattern is consistent because the mechanics are consistent. Forced selling creates prices that disconnect from value. Disconnections between price and value cannot persist indefinitely. When the forced selling ends, value reasserts itself, often rapidly and violently to the upside, as the same institutions that were forced to sell at panic prices recognize the opportunity and buy back in at lower levels. The institutions selling gold at $4,500 right now are not making an analytical decision that gold is worth $4,500. They are making a survival decision. Raise cash now, figure out the rest later. When later comes, when the margin calls are covered and the portfolios are stabilized and the immediate crisis mode passes, those same institutions will look at gold at $4,500 and silver at $70 in the context of 118 on oil, 3.9% core PPI, and a completely trapped Federal Reserve. And they will buy, aggressively, because they understand better than almost anyone what the macroeconomic environment demands from a portfolio allocation standpoint. They sold because they had no choice. They will buy because the math is undeniable. Part 7. The war is not ending, and that changes everything. I want to address something that is being quietly glossed over in most financial analysis right now. This war was supposed to be over in a week. That was the expectation. That was what the market priced. A short surgical operation. Achieve objectives, declare victory, restore stability, and watch oil prices come back down. We are now 3 weeks in, and here is what 3 weeks has produced. The Strait of Hormuz closed, Brent crude above 118, energy infrastructure burning across 4 sovereign nations simultaneously. North Korea firing missiles in a regional show of support. Saudi Arabia threatening direct military action against Iran. Qatar expelling Iranian diplomats and ending its role as mediator. Trump threatening to destroy South Pars entirely, which would cut power to 90 million people. This war is not winding down. It is expanding. Every week brings new escalations, new countries being drawn in, new infrastructure being targeted, new diplomatic relationships being shattered. The market that priced a 1-week surgical operation is now facing the reality of an open-ended regional conflict that is actively destroying the energy infrastructure of the world's most critical oil and gas producing region. Wars do not produce lower gold prices over the medium and long term. They produce liquidity crises first, and those crises cause temporary price dislocations, and then when the dust clears, they produce significantly higher gold prices as the inflationary consequences of sustained conflict work their way through the entire global economy. The question is not whether gold goes higher from here. The question is how long the liquidity crisis lasts before it does. Conclusion: what this means for you. If you are sitting right now watching your portfolio bleed, feeling the panic rising in your chest, wondering whether you made a terrible mistake, I want you to hear this clearly. The panic is real. The numbers are real. The losses on paper are real. I am not going to minimize any of that. I watch these markets every single day. I see exactly what you are seeing. I know what it feels like to watch positions you believed in get hammered in a market that seems to have lost its mind. But here's what I also know. Every significant correction in this entire precious metals bull market has felt like the end. The January crash from $5,600 to $4,400, that felt like the end. Silver crashing from $121 to $64, that felt like the end. Every single time, it was not the end. It was a reset, a shakeout, a transfer of metal and positions from weak hands to strong hands, from panic sellers to patient accumulators, and every single time the market recovered and went on to make new highs. I cannot guarantee that the same happens this time. Nobody can. The war could escalate beyond anything currently imagined. The Fed could make a catastrophic policy error. Some unforeseen black swan could appear. These risks are real and they exist. But what I can tell you, with confidence, based on data, based on fundamentals, based on the actual mechanics of the physical gold market, is that this is not 1979. The rally was not the same size. The demand is not speculative. The physical market is not loose. The interest rate environment does not have a Volcker moment coming. The most likely outcome is a range, $4,400 to $5,600 on gold, with the current move being the lower end retest of that range. The current selling is mechanical and forced, not analytical and fundamental. And mechanical forced selling creates the best buying opportunities available in any market, because you are buying genuine value at panic prices. Watch the levels. $4,500, $4,300, $4,000 on gold. $70, $64 on silver. Do not panic sell into the abyss. Do not let the chart overlay from 1979 override the actual data from 2026. Do not let short-term mechanical selling convince you that the long-term fundamental picture has changed, because it has not. The gold in your safe does not know that institutions are panic selling paper contracts. The silver in your stack does not know that refineries are burning. The physical metal sits there, real and scarce and finite, exactly as valuable as it was before the crisis, and arguably more valuable now, because everything the crisis reveals about inflation, about debt, about the fragility of energy supply chains, and about the limits of central bank power, all of it points in the same direction, higher. Not today, maybe not this week, maybe not this month, but higher. Because that is what the math says. And in the end, the math always wins.